Hello, I'm Jonathan Moyes, Head of Investment Research at Wealth Club, and today I'm with Richard Moore of Calculus Capital to talk about the Calculus VCT. So Richard, for those who aren't familiar, could you give us a bit of background to Calculus Capital and your own experience?
Of course. So at Calculus, we manage EIS and VCT funds. We were founded in 1999 and currently have around £150 million of assets under management. I am co-head of the investments team, which means I'm responsible for sourcing, diligencing, negotiating, and then completing new investments, and then assisting with the management of those investments once they've been made. I joined Calculus a little over 8 years ago. I joined from Citigroup, where I was in the investment banking team, advising technology companies on mergers and acquisitions and capital raisings. Before that, I was at JP Morgan doing much the same thing. And before that, I actually qualified as an accountant with KPMG, although that was a very, very long time ago.
So Richard, we're here today to talk about the Calculus VCT. What does it aim to do for investors?
Well, we've been managing VCTs since 2005. The current vintage, which investors can buy into as part of this offer, was launched in 2017. Funds raised will be used to invest in new opportunities as well as to support companies in the existing portfolio with follow-on rounds. That portfolio comprises just over 30 companies, so investors will be immediately exposed to those companies, and we're looking to increase that number to around 40. We back later stage growth companies, so typically that means we'll invest in what we call Series A or scale-up rounds. We don't look to invest in early stage or seed rounds. So our VCT comprises a well-diversified portfolio of small, predominantly private growth companies, and for investors we're targeting a 4.5% dividend yield and capital appreciation.
So are there any specific sectors or particular types of companies that you're looking to invest in?
Yeah, absolutely. So we focus on growth investing. So that in practical terms means focusing on the sectors of the economy that are growing the fastest. For us that means technology, life sciences and the creative media. In technology, that's mainly hosted software, which has a very good blend of rapid growth and high operating leverage. In life sciences, that's a range from diagnostics to drug discovery to medical devices. And on the creative content side, that means production companies feeding the large digital streamers. If there is a common thread that links all those three sectors, it's finding companies with a good blend of growth opportunity and defensible intellectual property. All of our companies need to have some form of core IP at their heart, which allows them a competitive advantage over their peers, which means they can grow quickly and also defend their position once they've grown.
Sure. And in terms of management teams, what do you look for in a good management team?
Passion is key. They must really believe in their business, strong domain knowledge and understanding of their chosen sector. Also someone we can work with, it's absolutely crucial. So we post-investment will work with a management team for a number of years. It's important that we want to work with them, but equally important that they want to work with us. The final thing I would call out on the management is they need to be willing to learn. No management team is the finished article, where when they come to us, they have developed a business to a certain stage, it's going well, but the path beyond that is complicated, and we want people who want to learn as they grow.
So are there any other red flags you might look for?
People who are too dogmatic, I would say, and people who are not willing to share the journey with those around them. Sometimes we see a management team who will dominate their executive group. These companies are small when we find them, but their intention is to be much bigger as they grow. And if we have a single entrepreneur or founder who is too dominant a person within his company, then it's unlikely to work out. So that would be a red flag.
Okay. And could you give us some recent examples of companies that you've invested in?
Yeah, absolutely. So, just last week we closed investment in a business called Hinterview. It's a software company, so a technology company. They offer a video interviewing product which they sell to recruitment agencies. It allows those recruitment companies to produce sort of video shorts, so 2-minute short interviews, which they then provide to their clients alongside a traditional CV. It makes the whole interviewing process much more efficient. You get to a good shortlist much faster, and it's just a much more productive process for both the client and the recruitment agent. It's a dynamic management team. It's growing very fast. It's generating recurring revenue from long-term contracts with its clients, and just the sort of business we like to invest in on the tech side. Another one that I call out on the life sciences side would be Invisius. We invested in them earlier in the year. They're producing a priming solution for dialysis machines. What this does is it coats the inside of the dialysis machine, which means it basically hides it from the patient's immune system, so that when the blood is flowing through the dialysis machine being cleaned, the immune system doesn't react to it and effectively end up causing inflammation and challenges. So it's very good health benefits for people who have to do long-term dialysis, huge global market, strong IP at the core, again, just what we're looking for. What would be a third one? The third one would be eConsult. We invested there at the beginning of the year. Actually, it's a good blend actually of technology and healthcare, because fundamentally it's a software product, but it's sold into the healthcare industry and built on good healthcare knowledge. So what that is it's a triage system and an SMS and video consultation platform for GPs. So it allows patients to go online, enter some fairly high level information about their symptoms, what they're looking to achieve, and then they get directed much more effectively to the sort of care they need. It could be as simple as a repeat prescription, and that can be provided digitally. It could be they need a face-to-face consultation. In the old way of doing things, everyone had to see a doctor straight away, so this allows the GP surgeries to be that much more efficient. And they're now live in almost half of UK GP surgeries and making a real difference for the NHS.
So quite a mature, established business then?
Relatively mature. I mean, it's grown extremely fast. If you think back 3 years, certainly 5 years ago, probably 3 years ago, most of this was not going on in the NHS GP surgeries. They were relatively static in terms of how they've been doing things. If somebody wanted to see a doctor, they saw a doctor and then they were directed. There's a huge amount of digital transformation going on throughout the NHS. As we all know, it needs to grow, it needs to evolve, and they're really supporting that. So very rapid growth.
So COVID really was a huge accelerant for that business.
It did, absolutely. There's no denying that. It made a big difference in terms of the adoption, both by patients and by GP surgeries, and a willingness to use these new technologies.
So within the existing portfolio, within the VCT, if we look at some of the more established holdings in the portfolio, are there any particular highlights, any companies performing particularly well, other than eConsult, which seems to be going?
Yeah, we'll leave that to one side. We talked about that one. So no, absolutely. I mean, there's more than 30 companies in the portfolio, so there's always lots going on. So good couple of examples, I would say, a business called Arecor, which we first invested in 2018. It's one of our life sciences businesses. They have a platform technology which they're using to develop a number of different drugs. The common theme there is for people with chronic diseases. The most advanced is one which is helping for people on insulin. So it's a very rapid acting insulin product, so diabetes patients. We first invested in 2018. We invested again actually earlier this year at their IPO. Second time. Market is very favourable towards this company. I'm pleased to say the price is up about 70% since the IPO earlier this year, and that IPO price was considerably up on our original investment price, so that one's working very well for us.
That was quite a large investment, wasn't it, from your EIS portfolio?
EIS and VCT, so most of our investments...
in 2018?
Yes, relatively large. I mean, where possible, we like to make a significant initial investment. It allows us a position of influence with the company. So a preferred investment for us will be for a significant stake, which could be anywhere from 20 to 40%. That means we take a seat on the board, we get to be active around the management of the company, they will listen to our advice, and we are able to contribute to the growth and development of the business.
So how has the pandemic affected the VCT's portfolio?
It's been remarkably resilient, and you never want to say beneficial, but certainly when you're sitting on a portfolio with a number of life sciences companies, there are certainly ones which have benefited from what's happened. You've already called that eConsult. We have a number of others in the diagnostic side, a business called Mologic, which was producing lateral flow tests, which are very topical. We all know how those work now. So on the tech side, extremely robust. What we're looking for in tech is that hosted software, recurring revenue, predictable future, which works extremely well. And so that's been robust and solid and has grown as predicted. On the life sciences side, we've had some which have really had a huge boost from the pandemic. So across the portfolio, it's actually been quite strong.
And so besides funding, you touched on it, taking large stakes in companies early. What do you do practically to help these companies succeed,
Yep.
other than just capital?
Predominantly, it's us, which sounds dreadful. That's us blowing our own trumpet, but that is the truth. So we have an awful lot of experience between us of helping these companies grow, both from prior experience and from the many years we've been working at Calculus, seeing what it takes for a company to make it. So post-investment, usually one of our investment directors will take a seat on the board. That means we attend monthly board meetings. We are also on the phone to someone in the company probably at least once or twice a week. We're quite active in terms of seeing how they're getting on, spotting the challenges 1-2 years out, which a relatively new management team may not be aware of. So that advice and guidance is absolutely crucial. We know what good looks like, and that's what we're trying to get them to. In addition, we do have a network of sector experts around sales, marketing, finance, technology, different areas where a company may stumble, and they can always tap into that.
Sure. And so investing in companies at a very early stage, it's obviously, we've touched on some successes. What are the risks? How many companies are you expecting to fail?
It's a very good question. It's the right question. I always find it an emotionally challenging one to grapple with, just because, well, my professional pride would say that any company we find, we diligence, we negotiate, we work with should succeed. But as you point out, these are early stage companies. Their profile when we invest, they've probably got $1 million, maybe a bit more of revenue, maybe 25 employees. For all of them to succeed, well, it would be illogical. That we wouldn't be taking enough risk to generate the growth from the successes we're trying to do. So to give you a direct answer, we are investing in later stage companies. We're avoiding seed, so the failure rate is higher. But in practical terms, it's probably about a third won't make it.
You mentioned there you look to invest in companies with $1 million of revenue or more. Is that fairly typical within your portfolio?
It's very typical, but given the spread of different sectors we're investing in, it can't be a hard and fast rule. So, for example, the company I mentioned earlier, Invisius, on the life sciences side, very often life sciences companies won't really have revenue when we invest. They are an equivalent stage of maturity to a business from another sector that would have that level of revenue. They've got IP, they've got patents, they've got science, they've got trials, but the milestones are different. The easiest one for most people to understand from a practical real-world company example are the hosted software companies. And what we found is if you've got to £1 million of recurring revenue, you have something that with demonstrable product market fit. Often we see companies with 400 or 500k of revenue. It feels quite good. You want to believe in it, but it can often be significant trials with 2 or 3 large customers. You can't really get to grips with, is this what the market really needs? You get to £1 million of recurring revenue, there's enough touch points, there's enough customers we can speak to understand really whether it's going to work.
Sure, makes sense. What about exits? Have you had any exits in the portfolio recently?
It's been a good year for exits. I mean, across the market, there's been an awful lot of M&A activity, and we have benefited from that as well. So a couple of examples, a month or so ago, we sold a business called CloudTrade. That was sold to a strategic acquirer called Advanced. And that was a business we invested in mid-2018, so relatively short hold period, just over 3 years. And that returned a 4 times return on the capital invested for the VCT. So that's a little over 50% IRR, so very pleased with that one. Another one to highlight was earlier in the year, a business called Melogic, which was on the life sciences side. They focus on lateral flow tests, predominantly around tropical diseases such as dengue fever, but obviously they do have a sideline in lateral flow tests for COVID-19 as well. Interesting deal that, because that was sold to a not-for-profit organisation. It's a foundation supported by the George Soros Group and also the Bill and Melinda Gates Foundation. So a for-profit company has been sold to a not-for-profit organisation, but that's fine. It produced a good return for the VCT, and the management are now moving to focus on delivering that lateral flow technology to developing countries and helping with those tropical diseases, which is a good result for the company and for the VCT.
Oh, good. And how about the performance of the VCT as a whole? How's it performing?
It's been good. We're pleased. So we value the portfolio of private companies twice a year. The annual numbers are actually externally audited. When COVID hit, we did mark it down. It was practical, it was logical. There were a number of macroeconomic risks that couldn't be quantified. So we marked it down then. But as we discussed, portfolio has been very resilient since that time, and we've maintained the dividend target through that, so we've hit it. And also the capital value has been appreciating since that early COVID low.
Hmm. So you mentioned the dividend target there, 4.5% per annum. Are you confident of achieving that going forwards?
Yes, we are. So that target has been in place for the last 5 years, and we've met it every year for the last 5 years. So the structure of the VCT, with our focus on the more mature companies with proven product market fit, high growth opportunities, it allows us to keep doing those exits, which ultimately fund the dividend return. So yes, we are confident of continuing to meet that target.
Okay. So to sum up then, Richard, I have some money I want to invest into a VCT this year. Why should I invest in the Calculus VCT?
Well, we've been investing in early stage growth companies for over 20 years. During that time, our core investment philosophy hasn't really changed. We find strong management teams with a product with proven market fit, a high growth opportunity and defensible IP. It is exactly the strategy that the current legislation is driving everyone towards. It's encouraged by the legislation. We are in a good position, and that's the same philosophy we've been pursuing for over 20 years. So it's a well-diversified portfolio of high-growth companies, and we're targeting a 4.5% dividend yield and capital appreciation for the investors.
Richard Moore of Calculus Capital, thank you very much.
Thank you.